This is an Uncovered Japan Company research report on Nohmi Bosai, ticker 6744. Nohmi is Japan's largest specialist fire protection maker. It sells the alarms, sprinklers, and suppression systems that buildings need, then maintains them for decades under legally mandated inspection cycles. That creates a defensive installed base annuity, but investors still need to decide whether the current valuation already reflects the quality. At the report's reference date, Nohmi traded on 18.1 times forward earnings and 1.78 times book. Fiscal 2026 operating margin reached a record 13.1%, while return on equity was 9.6%, and the equity ratio was a very conservative 76.2%. Those numbers capture both sides of the story. Excellent operating economics, but a balance sheet carrying more capital than the business needs. The product is easier to understand as a life cycle. Nohmi manufactures detection and suppression equipment, designs and installs it in a building, conducts the legally required inspections, and ultimately proposes replacement when the equipment reaches end of life. The same installed base is both a switching cost moat and the source of future maintenance and renewal revenue. It is a stock revenue machine built around a life-critical physical system. Nohmi's three main segments each have a different job. Fire alarms represented 36.5% of fiscal 26 sales, and CB installed base. Fire extinguishing represented 33.6% and is more exposed to large, lumpy projects. Maintenance and inspection represented 26.3% of sales, but it is the recurring annuity. It grew from 26.3 billion yen to 36.7 billion yen over 5 years, with roughly a 22% segment margin. The financial trend has been strong. Fiscal 26 revenue reached 139.7 billion yen, operating profit 18.3 billion, and net income 13.6 billion, all records. Revenue compounded at 5.5% a year over the 5-year period, while operating margin rose from the fiscal 23 trough of 8.4% to 13.1%. 4 consecutive annual price increases were an important contributor to that improvement. Nohmi is effectively debt-free and has a fortress balance sheet. The equity ratio stayed around 76% in fiscal 26, while ROE recovered from a 6% low to 9.6%. That conservatism makes the downside more resilient, but it also explains why Nohmi earns a lower return on equity than its listed fire safety peers. The central re-rating question is whether management can lift ROE durably above its 10% target. Management has begun addressing that excess capital. Dividend per share rose from 36 yen to 116 yen over 5 years, and the payout target rose to 50%, achieved in fiscal 26. Nohmi also has a no-cut dividend record going back to 1979 and resumed buybacks, repurchasing roughly 3.7 billion yen in fiscal 25. More capital returns would be the most direct way to lift ROE. Vision 2028, Stage 3 targets revenue of at least 170 billion yen, operating margin above 12%, ROE above 10%, and a 50% payout ratio by fiscal 29. The margin and payout goals are already achieved. Revenue was 139.7 billion yen in fiscal 26, and the record order book was 161.2 billion. Demand appears visible. Execution capacity is the more important constraint. The most durable driver is equipment replacement. Systems installed around the 2011 building wave are entering their replacement window, and management says that cycle extends beyond 2028. Renewal-linked work is roughly 40 to 45% of revenue. Redevelopment and data center construction help new build demand, but the key operational risk is skilled installer capacity. If Nohmi cannot staff installation work, a record order book will not convert into revenue as quickly as investors expect. Against its 2 listed fire safety peers, Nohmi looks fairly valued rather than deeply discounted. Its 18.1 times forward earnings sits near the peer median, while its 1.78 times book is the lowest of the group. But that ranking maps closely to its lower 9.6% ROE. The lower price-to-book ratio is not automatically a mispricing. It is conditional on Nohmi improving capital efficiency. The report's fiscal 29 scenarios are explicitly assumption-based, not price targets. The bear case combines weaker pricing and cost pressure with a 14 times multiple, implying 3,034 yen, about 28% below the reference price. The base case reaches 4,831 yen, or 15% higher, while the bull case reaches 6,460 yen if margins, Meisei integration, and ROE all improve. Monitor margins, maintenance growth, order conversion, and ROE. To sum up, Nohmi Bosai is a regulation-protected specialist with a large installed base, a statutory maintenance annuity, record profitability, and a very resilient balance sheet. The offset is that the stock is not a straightforward bargain. The controlling Seicom stake creates governance and liquidity considerations, and valuation depends on ROE moving above 10%. The most useful indicators are maintenance growth, pricing, installer capacity, M&A integration, and capital returns. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.